talk real estate for a moment, because this really cuts into what people are feeling in terms of their own wealth. Real estate was already slowing going into this sell-off, right? I mean, I was with a real estate broker actually last night, and she said, look, things are just sitting there. It's stagnant. And it's only going to get worse because these two markets are in conjunction, right?
Higher, longer-term rates moving up will hit the housing market in the areas that have seemingly been resilient, like your major metropolitan areas. And I think you have higher interest rates. Those mortgages become more expensive instantaneously. The banks, by the way, if you try to go and get a 30-year fixed-rate mortgage, they have raised those rates immediately, right. Number one. Number two, you've had the lowering of the mortgage interest deduction, and then the cap on property tax deductions. We were talking to one of the executives here. That has a real psychological impact on what people are willing to pay in these areas. And we tend to focus on the major cities, but there are a lot of parts of this country that never recovered from the housing collapse. That came back. Drive an hour outside of New York City into Upper Connecticut, and those home prices are still below. There's a lot of inventory, and the home prices are still below where they were at the peak back in, 2006, 2007.
But look at the bump that happened when the tax cuts came through. A lot of corporations had a lot more money, and a lot of people said the stock market took a rise on the tax cuts. Now we're seeing the back end of that. There's always a reaction, and the rising taxes is going to be, the rising interest rates is going to have a real impact on that. And
taxes as well, because there are some markets that obviously their taxes went up, like in New York, when you lost the SALT deduction. So that will... People, you don't see it until you see it, right? I mean, you know that your taxes are going up because you lost that SALT deduction, but when you actually see it come April and you have to pay money, that could actually hit the real estate market hard.
Yeah. Yep, when it becomes reality, that's when you see a reaction and action taken. And I think that's what you're seeing in the stock market also over the last couple of days with these pre-announcements and companies talking about higher raw material costs, higher transportation costs, higher oil, potential for tariff implications going into the out quarters. And so as an investor, how do you react to that?
So, first of all, you don't overreact. Nobody's heading for the hills in Tiger 21. Most of our members have a diversified portfolio. It's only 24% exposed to the public markets to begin with. A lot of private equity and still income-producing real estate. And the other thing is there's nothing particularly unique about this moment. We've been here before. It happens episodically. Could get a lot worse. It's like we had 2 storms yesterday, a hurricane.
Yeah, we did.
This one could get worse, but right now there's nothing to be panicking about.
Also, on the bright side, you look at the mid-2000s, we tried to conjure economic prosperity from investing in housing. Didn't work very well. In some ways, this is kind of a sign of the strength of this economy right now, that it's not driven by overinvestment in residential real estate.
Well, the FANGs, all of the technologies, innovation, these competitive moats, they've gotten the benefit of look at how the market's still way up for the year. So.
But one thing I wanted to point out, and we hear this on Twitter, the viewers will alert us to the people who were the most responsible in the last decade or more, who saved their money and just wanted to keep it in safe assets. They're the ones who got screwed, quite frankly, with 0% interest rates. That doing the right thing and saving and investing in the haven assets like treasuries, they didn't get paid. They're finally going to get paid because of the higher interest rates.
Yes.
So they're chafing a little bit at the lecturing because they did the right.
The guy with the biggest smile in our meeting yesterday is all in index funds, and I looked over the last 10 years, combined returns of 11.8%. That's 3 times money. He hasn't done anything but let the money roll. So I would say the more conservative people were in index funds and balanced, not just in treasury bills. And you don't have to be a stock picker. If you get exposure to the market, even with yesterday's 4% downturn, you're still up 3 times. $10,000 is $30,000 today. Yeah. Still pretty amazing.
And let's not forget the fees are so much lower than anywhere else. By the way, your members are big into private equity. What's your thought today on one of the top stories in the Journal? BlackRock diving into private markets. BlackRock and Larry Fink, its CEO, investing with private equity firm Gallatin Point Capital.
So, look. Private equity is more awash in money than it's ever been, more money raised this year. That's why I'm saying you're better off as a seller than a buyer. And that's where our members are looking. These are entrepreneurs who built businesses from scratch, and now they want to invest their money in small businesses that, if they can build the potential, will have a great future.
All right, we'll keep watching that. Michael, good to see you.
Thanks so much.
Thank you so much. Michael Sonnenfeldt joining us there.